Hey there. Have you ever seen a headline like the Fed raises interest rates and suddenly the stock market crashes, your mortgage goes up, groceries get more expensive, and everyone starts freaking out? Surprisingly, a lot of those decisions are made by officials you didn't elect, the central bankers. The truth is, central banks have way more power over your money, your job, and your economy than most people realize. So in this video, we're going to explain what a central bank is, their roles and powers, how their actions affect markets and your wallet, what happens when they mess up, and who actually owns them. And just a quick disclaimer, this video is only here to explain the concept of central banks and how they work. It's for educational purposes only. Now let's get started. Section 1. What is a central bank? Simply put, Section 1, what is a central bank? Central bank is like the big boss of all the banks in a country. It helps control how money flows through the economy. It can create new money, decide interest rates, and maintain the banking system. So it doesn't work like a normal bank. No debit cards, no personal savings accounts, no ATMs. Instead, it works behind the scenes, acting as the bank for the commercial banks you use, like HSBC, Bank of America, or the SBI. Right now, almost all countries in the world have their own central bank. There's the Federal Reserve in the US, the European Central Bank in the EU, the Bank of England in the UK, the Reserve Bank of India in India, and many others. Section 2. The three powers of central banks. Section 2. The roles and powers of central banks. Every central bank in each country has different jobs, but most of them are supposed to do three things: keep prices stable, keep the banking system safe, and keep the overall economy running smoothly. That's the official story, at least. Whether it works or not, that's another debate. In order to do these tasks, they also use three big tools. Let's go through each one. First, interest rates. Every time you borrow money, whether it's for a house, a car, or a credit card, the bank charges you interest. That's like the profit the lender makes when giving you the loan. But what decides how high or low that interest is? It starts with the central bank setting the base interest rate, which influences the rates other banks offer. So when the central bank raises this rate, borrowing money becomes more expensive. That means people take fewer loans, buy less stuff, and spend less overall. If fewer people are buying things, then sellers have to lower prices or at least stop raising them to attract buyers. This helps stop prices from rising too fast. On the other hand, if the economy is weak and people aren't spending, this can crush businesses, lead to layoffs, and spiral into a deep recession. So when the economy is weak, the central bank can cut interest rates. That makes borrowing cheaper, which encourages people to take loans, buy things, and invest. This helps boost the economy again. So interest rates work like a gas pedal or brake pedal. Raising them might slow things down, cutting them might speed things up. Remember, keeping interest rates too low for too long can cause high inflation. That's why most central banks aim for around 2% inflation per year, their magic stable number, usually measured using something called the Consumer Price Index, or CPI. Second, creating money. Of course, central banks can print physical cash, but today, around 92% of the world's money is already digital. If there's too much money, it can cause inflation. If there's too little, it can lead to deflation. To manage this, central banks use a method called open market operations. Here's how it works. When the economy is weak and money isn't flowing enough, the central bank wants to increase the money supply. This is called an expansionary open market operation. The central bank creates new digital money by literally typing numbers and uses it to buy government bonds, usually from commercial banks. When the central bank does this, it gives commercial banks reserves. Reserves are a special type of money that only banks can use with each other, not with the public. But do banks then use these reserves to lend directly to people? The answer is no, because in modern banking, commercial banks don't need reserves to make loans. When they give someone a loan, they just type new numbers into that person's account, creating money from nothing. This is called the fractional reserve system. The extra reserves just make banks feel safer and more willing to lend. But again, this differs across countries. And when banks compete to give out loans, they often lower interest rates to attract more borrowers. So people and businesses who borrow more money will have more money. This encourages people and businesses to spend more, which increases the money in the economy and pushes inflation up. Now, if inflation gets too high, meaning there's too much money going around, the central bank does the opposite. This is called a contractionary open market operation. The central bank sells government bonds to commercial banks. To buy these bonds, commercial banks use their reserves. With fewer reserves, they become less willing to lend. As a result, banks raise interest rates, borrowing slows down, and less money flows into the economy. This helps bring inflation down. But when the economy is in a serious crisis and the central bank needs to inject a huge amount of money quickly, it uses a more extreme version of this strategy called quantitative easing, or QE. Simply put, QE is the same thing as expansionary open market operations, but on a much bigger scale. This makes long-term interest rates go down. That's helpful for borrowers, but it also pushes big investors and companies that get this new money to use it to invest more in investment assets like stocks or real estate. Prices go up. The people who already owned those assets get richer. But this also fuels inflation, especially in housing and other investments. That's why some critics say QE makes the rich richer and the poor poorer. Third, supervising and rescuing banks. The central bank also acts like a watchdog. It sets rules and monitors commercial banks to make sure they're not taking too many risks. And if something does go wrong, the central bank becomes the last resort. That means it steps in and gives emergency money to banks that are about to collapse. This helps stop one bank's failure from spreading to the rest of the system. For example, in 2023, Silicon Valley Bank collapsed after a wave of panic when many companies suddenly tried to pull out their money at the same time. This caused a bank run. While the Fed didn't rescue the bank directly, it acted quickly to calm the situation, guarantee all deposits, and prevent the panic from spreading to other banks. But these powers are not always perfect. Sometimes the central bank waits too long before acting. Other times, its own decisions, like keeping interest rates too low or printing too much money, helped create the very bubble that ended up popping. Now, if the central banks can control your money, at least you should control your own accounts and passwords. This video is sponsored by Proton Pass, a secure password manager built by the same privacy-focused team behind Proton Mail. It lets you store your bank logins, credit cards, and crypto wallets in a secure vault backed by Swiss privacy laws, some of the strongest in the world. And here's the best part. Proton is 100% funded by its users, not from ads, so their focus stays on building privacy tools that actually serve the users. And even the free plan also has no ads. So check out Proton Pass now using the link in the description to get 50% off a yearly plan. And yep, there's a 30-day full money-back guarantee. Now let's get back to the video. Section 3. Why markets panic when central banks speak. It might sound strange, but sometimes just a few words from a central banker like the U.S. Federal Reserve Chair can shake the entire country or global economy. Why does this happen? Because people are always trying to guess what the central bank will do next. Will they raise interest rates? Will they cut them? Will they create more money? These decisions affect whether the economy speeds up or slows down. So big companies, banks, and investors pay close attention to every speech, every sentence, and even every single word. For example, in June 2021, the Federal Reserve Chairman Jerome Powell called inflation transitory, which meant temporary. So investors stayed calm because they thought inflation was just temporary and would go away on its own. So there was no need to worry about interest rate hikes or a slowdown. But on 30 November 2021, he reversed and said inflation wasn't going away. That tiny shift in language caused panic. Markets dropped fast, investors realized the Fed might raise interest rates sooner than they expected, and they rushed to react before it happened. But this isn't just about investors or Wall Street. When the central bank raises interest rates, the effects eventually hit everyone. If you're trying to buy a home, your mortgage interest becomes more expensive. If you're paying off a credit card, your interest charges go up. If you're renting, your landlord might raise the rent to cover their higher costs. Companies that borrow money will face higher interest costs. To cope, they might cut spending or lay off workers, which slows down their business, and that can cause their stock prices to fall. That's why rate hikes usually make stocks fall and rate cuts usually make them rise. But it's not a guarantee. If a rate cut happens during a crisis or unstable economy, it can actually scare investors even more because it signals that things might be worse than they thought. There's also a global side to this. For example, when a central bank like the Federal Reserve raises interest rates, the country's currency, in this case the US dollar, often gets stronger. That's because foreign investors are more interested in buying US bonds. Why? Well, government bonds are when the government borrows your money and promises to pay it back with interest. So higher rates mean the government pays more interest, which attracts investors.
To buy U.S. bonds, investors first need to buy U.S. dollars, so they compete for the dollar, which drives its value up. A stronger dollar sounds nice, but it can cause problems too. First, it makes U.S. exports more expensive for other countries to buy. That can hurt exports. And second, many countries borrow money in U.S. dollars. When the dollar gets stronger, it becomes harder for them to pay back those loans, which can cause trouble in other countries that have lots of debt in U.S. dollars. Well, if you want to understand strong versus weak currencies, check out my video, Why Do Countries Want Weaker Currencies? Link in description. Section 4. When central banks get it wrong. Central banks have a lot of power, but that also means they can make big mistakes. In this video, we'll talk about 2 times when they got it wrong. One example is the 2008 financial crisis. After 9/11 and the 2001 dot-com crash, the U.S. Federal Reserve kept interest rates very low to stimulate the economy, even down to 1%, a historic low. This made borrowing cheap. Banks lent more money, and many people rushed to buy homes with easy loans. Banks gave out loans with very little checking, and people got mortgages they couldn't afford. Home prices kept rising, economy was booming, and everyone thought the boom would never end. But it was a bubble, and eventually it popped. The entire housing market collapsed. Banks began failing, including one of the biggest at the time, Lehman Brothers, and millions of people lost their homes, jobs, and savings. While the Federal Reserve wasn't the only one who caused the bubble, its earlier policies did play a role. Sometimes central banks follow the textbook formula, but they miscalculate how people will react. For example, Japan had a similar bubble with the 2008's US, but they got it in 1991. Japan's central bank kept interest rates near zero for over 20 years to encourage Japanese people to borrow more and spend more money to stimulate the economy after the crisis. They created new digital money and bought government bonds, a strategy similar to QE. But they miscalculated. After the bubble, many Japanese people were traumatized by debt, so they chose to save more and avoid borrowing. The central bank even offered negative interest rates of minus 0.1%, but people still didn't want to borrow. This was made worse by Japan's aging population and low birth rate. So, the economy stayed stuck, and now Japan's central bank owns a massive chunk of the country's debt. This is one of the reasons Japan's government debt has grown to over 200% of its GDP. So, that's why central banks are called the most powerful institutions in the world, because when they mess up, the damage can cost billions or even trillions. Section 5. Who owns the central bank? One of the most important things people are told about central banks is that they're independent. That means they're supposed to make decisions based on what's best for the economy, not what politicians want. In many countries, politicians still try to pressure the central bank behind the scenes, but it's usually not easy because their independence is protected by law. Or in some countries like China, the central bank is fully controlled by the government, so it has no independence. That's why central bank structure and methods might vary across countries. Now you might think, why are there so many conspiracies about central banks? Well, it's controversial because of how it started. Since each country's central bank has a different story, let's look at the US as an example. It all started after a major panic in 1907 when people rushed to withdraw their money and caused a bank run. The US government was helpless. It had no central bank at the time, so it had to ask big bankers like JP Morgan to step in and use their own money to bail out banks. So yeah, really one-man private central bank. So, after that crisis, they wanted a system that could step in during emergencies. In 1910, 2 government officials and 4 big bankers, 6 people in total, though some versions say 7 or 8, met in secret at a private resort on Jekyll Island, Georgia. That meeting became the plan for a central bank, and in 1913, the Federal Reserve, the U.S. central bank, was officially created. So who owns the central bank itself? Well, this is the tricky part. In most countries, central banks are officially fully owned by the governments or public. But in a few places like Belgium, Japan, Greece, Turkey, and Switzerland, the central bank is still half owned by the government, yet they also have publicly traded shares that anyone can buy, except Turkey, that is not on stock exchange. These shares don't come with voting rights or control. They're mostly symbolic. You just own the stock but have no power over decisions. Now, in the United States, the Federal Reserve is officially a strange mix of public and private. So, the main board or the headquarters is in Washington, D.C., and its members are appointed by the president and confirmed by the Senate. But the Fed also has 12 regional branch banks across the US. And here's the weird part. These branches are partly owned by private commercial banks in their areas. These banks are legally required to buy shares in their local Fed branch and get a small fixed dividend in return. But they can't sell those shares or control any major decisions. At least that's the official explanation. Yeah, I know, it's confusing. This strange public-private setup, the secrecy during its creation, and the involvement of powerful bankers made people suspicious, wondering whether the central bank really exists to stabilize the economy or if it's secretly owned by elites trying to control everything from the shadows. Yeah, that's the theory. Conclusion. So, in conclusion, central banks are some of the most powerful institutions in the world, yet most people barely understand what they do. You don't vote for them, but their decisions affect your life every single day. They control interest rates, they influence inflation, they shape the economy in ways that influence how confident businesses feel, whether to hire more workers or lay people off. So, the next time you see a headline about a Fed decision, now you know why everyone's freaking out, because those decisions really do affect millions of lives, including yours. Help us keep making videos like this by becoming a member and unlock some exclusive perks too. If you want me to make other videos explaining these topics, please like and subscribe. Thanks for watching.